Good morning, Mr. Bryan Gould. Thank you very much for doing this. I really appreciate your time.
Good morning. Thanks for having me this morning. It's a real thrill to be here.
For the listener, you are the founder and executive chair of Aspenleaf Energy. But what is Aspenleaf Energy?
So, Aspenleaf Energy, we're a private light oil company. We've got 3 assets. Our assets are in central Alberta. We started the company in early 2014. We had a different strategy. So we're a private company. We're backed primarily now by ARC Financial.
Mm-hmm.
And we started the company with a view of a strategy that was, I would say, different than most private equity companies. But we also had a vision of a culture that we wanted to put in place. And we had some, I would argue, differentiated skill sets. So it was a combination of kind of strategy, culture, and skills that we started the company on. And, a dozen years later, here we are producing 25,000 barrels a day, very profitable, and, aiming to keep the company going.
A few months ago, I did a podcast with Mr. John Dealert, your chairman, but we had technical difficulties. At this point, I was sweating, so I didn't think the interview would even happen. So we're doing better today than a couple months ago.
Perfect. Well, if you'd like, John can come back and you can continue with him too.
Yeah. Well, he might be in for part 2 one of these days, but at least for today, we're doing all right. Producing about 25,000 BOE a day, I think?
Yep.
Oil and gas?
Light oil. So obviously it has associated gas with it, but we're about 80% liquids. Our business model, so we believed, just from a business environment standpoint, we were keener on light oil and its prospects. But when we started the company, I brought my partners, co-founders, we all came from Shell. And we knew we wanted to be sort of in the light oil, liquids-rich gas business, and we had enough experience and breadth that we could go wherever we saw the opportunities. But we saw opportunities in the light oil space, and that's where we are now. But I wouldn't say that we're necessarily restricted to do that forever. We've got bandwidth to do more if it makes sense.
For the listener, in some context, at 25,000 BOE a day, which is a majority of liquids and oil, that would, on public markets, be maybe around $1 billion market cap these days. So
that's probably about right. Yeah.
So sizable company.
It's not as big as Shell where we came from, but we started from scratch, and it's something we're very proud of.
Things are going well.
I'd say things are going very well.
But to get back to the beginning, maybe your journey in energy. Originally, I think you're from Toronto?
Yeah. So I grew up in Toronto, also known as the center of the universe. Went to university there, so I studied chemical engineering. I actually went into that thinking I was quite interested in nuclear power at the time, and I thought that's where my career would head. And then through my studies, got introduced to the oil and gas business. There was one particular professor who was doing consulting work for a company called Amoco, and I got quite interested in that. And it was really at the formative stages of oil sands.
Mm-hmm.
And then, the job market was booming back then. This is the late 70s. And so started coming out to Calgary for summer jobs and worked for Amoco. And so things came together, loved the business, stayed on for a postgraduate degree. And day I finished, got in my car, drove to Calgary, and this is where I've been ever since.
So you were doing summer jobs in university out in Alberta.
Yeah.
Which is originally how you got into the sector.
Yeah.
And so you could see the opportunity.
There was something about the industry that I just found tremendously appealing. I've been working in it now since the late 70s. I think it's the most remarkable industry on the face of the planet. It's got everything. It's got finance, technology, geopolitics, and I think it is fundamentally critical for human prosperity. So yeah, it's got everything.
Was it kind of a big step to come out to Calgary and leave your family behind? Was it tough to make that decision?
Never gave it a second thought, actually. It just seemed like the obvious path.
Hmm.
and I've never looked back from it or had a day of regret. So,
And to the listener, your family has a pretty interesting history. Your parents, I think, came from tough circumstances, late 30s in Europe when the Nazis took over Czechoslovakia. Your mom made it over to Canada, but your dad did. Maybe brief history. Why was it such a tough period?
well, yeah. So I mean, my parents survived, what some would say was unsurvivable. And it has forged kind of my outlook on life. And I'm tremendously grateful for the country because this was the only country that they could come to. And so I've got a lot of passion for Canada, a lot of passion for kind of Western civilization fundamentally. And I spend a lot of time now, frankly, trying to pay it forward for next generations too. And we all come from our beginnings and our roots in some fashion, and mine's a little bit more unique than others, but uh, life has unfolded for me in a way that I would have never believed possible, and I'm very grateful for that.
Originally from Czechoslovakia, 1939, Germany invaded. Your mom was 7 years old. She got out, but your dad didn't. He spent the next 10 years roughly behind the Iron Curtain before he made it over to Canada, which would have been really hard.
Yeah, he survived, the Holocaust miraculously, and then had to escape from behind the Iron Curtain. And so again, I'm very grateful for democracy and free market economies and all the things we have here. And I understand how fragile they can be. And to me, it's really important that we fight for them.
Like what you're saying, we can't really live or do justice to those experiences on this podcast, but it's a good frame of reference, maybe on a bit of your history. And your dad also was in a camp with Viktor Frankl, which, if anyone's listening, Man's Search for Meaning is a good book to read.
Absolutely. Yeah.
But you, like you said, you ended up in Calgary after a while. Do you remember your first day in Calgary?
I do. So I left Toronto. It was really hot. There were all these forest fires in northern Ontario. I was driving out, and on the radio, they said the Trans-Canada Highway was closed at Regina because there was a blizzard. This was May 29th. And I thought, this can't be possible. But I got to Regina, and indeed, the highway was closed. So I missed my first day at work because I couldn't get through. But I showed up, at Shell the next day.
Mm-hmm.
You know, just keen to get going. Obviously not knowing what I didn't know at the time. And, I joined Shell thinking I'd be there for life. I ended up working there for almost 29 years. And yeah, I don't have a single regret for the time I spent there. I learned a ton. They gave me opportunities to work on projects that, were mind-boggling. And yeah, it was a great time.
29 years at Shell is rare, especially through the 1980s energy program. And were you thinking at the time that you'd stay that long?
We were a little different back then. Quite candidly, like I didn't think of, you didn't think about your whole career and how it was going to unfold. You just went one step at a time. Now, when I joined Shell, they had a pension program. They had a defined benefit pension.
Mm-hmm.
And at that time, everyone retired at 50 because you could get a full pension. And it was shortly after I joined, they changed the pension plan and they moved retirement to 55. But the mindset was, you work till you're 55 and then you retire. And for a lot of years, I thought, well, I'm just, the goal line was 55. And now I don't even think about retiring. But you didn't really worry about your whole career unfolding. You just lived one day at a time.
This episode is brought to you by Bedell Gas Compression. Proud to be recognized as an industry leader, Bedell Gas Compression specializes in reliable, custom-engineered natural gas compression solutions that support efficient operations. Backed by experienced field service and an unwavering commitment to safety and performance, Bedell is a trusted partner in the field. From flexible rental options to fully customized new builds, the Bedell team focuses on operational efficiency, safety, and long-term performance, helping producers keep gas moving where it matters most. Learn more at bedell.com. So the idea was you'd start 22, 23 years old and work at Shell till you were 50, and then that was it. You had some money coming in until you died, basically.
That was the picture. Yeah, pretty much. Yeah.
And that was relatively common. Do you know many people that ended up with that? The pension program like that?
I would say, yeah, lots retired, made it to, their 55-year goal line and retired.
Mm.
But what was remarkable at the time at Shell, I don't know if there was something in the water there, but there were 2 or 3 floors in the Shell building. And when I look back, I estimate that at least 24 future CEOs came out of those floors at Shell. And there was something about who got recruited. I don't know exactly what it is, but there was an entrepreneurial spirit that came out of it. And, many of my former colleagues are still working today too. Notably, like Mike and Sue Rose, John Dilward, who you talked about, is still going.
Mm-hmm.
Many others as well.
Brian Schmidt will probably miss somebody, but
yeah, Brian Schmidt. Worked with Alex Verge, Tom Mullane, Richard Baker, Jonathan Wright, and I'm sure I can't remember all the names on the spot, but lots of great people.
The idea was Shell was a great place to work and they'd take care of you, but there was times where they ended up laying off a lot of people too, and it didn't turn out the way a lot of people thought it was. When did you realize that maybe things weren't as safe as you thought they might be?
For me, it wasn't safety. I decided to take early retirement. So I worked for Shell Canada, and then it was a publicly traded company, but the majority interest was owned by Royal Dutch Shell. And I had a super good relationship with the folks in The Hague, and there came a time when they decided to buy out the minority interest. I actually was working to represent the minority interest and thought I was going to get fired when the deal got done, but they promoted me. And the idea was that Calgary was going to be a hub and Houston was going to be a hub. And that sounded good to me. And, I was able to do some other large transactions once we were essentially taken private by Shell. And then there came a time, a new CEO, he was doing another wave of cutbacks. And the procedure at Shell was everyone had to reapply for their job. And at this point, I was an executive, an officer of the company, and I found it quite demeaning, frankly, after 29 years to be reapplying for my job. And it was clear that Calgary was not going to be kind of a major hub. It was going to report in through Houston. And it was just something that I didn't want to do. I'd been doing a lot of business development, flying around the world, so I was away from home a lot. There were lots of big company politics, and it just seemed like it was time to move on and do something else. And so I took early retirement, actually with the view that, maybe I was just going to retire. And I ended up being retired for only a couple of days. And then I went to work at Athabasca Oil Corp. And there's a whole reason for how I ended up there. And I stayed there for 4 years. That was not the right fit or place for me, but it was kind of a launch pad for me to eventually start Aspenleaf.
And when you're at Shell, you got to study a lot of assets through the years and see a lot of deals. And so through the 80s and 90s, did you start to get a sense of the opportunity in Canada, Western Canada, with the oil sands and all the liquids rich and the Montney? And did that unfold for you?
Yeah. So I started out as a very technical person, and because I had a graduate degree, they initially assigned me to work in research, which wasn't where I wanted to be, but that's where they wanted me to be. And so I worked for about 5 years in research, including an overseas assignment in The Hague. And eventually I made my way to one of the business units, so the oil business unit. And that's kind of where I really found my niche. Fairly early in my career, I was asked to work on an acquisition evaluation. And back in those days, there was no M&A group. People didn't do, acquisitions. I was quite adept at computer coding, and so I could access and analyze data. I could do the work of 100 people with a computer. And so worked on a first acquisition project. Shell was looking to assess buying a company called Cantera at the time. And so I kind of figured out, well, how do you do this? And it was just me, really, and a few people. And we ended up not making that acquisition. And shortly after that, Cyclical Canada came up for sale. And so I worked on the evaluation of the upstream assets. Spent, I think about 4 or 5 months doing that kind of round the clock, day and night. And what it did though is, I was like fairly junior person in the company, but you get access to senior management when you're doing that kind of work. So we ended up making a bid for Texaco, but Imperial Oil, Exxon's affiliate, ended up buying it. And then I kind of went back to my normal jobs. But what I find interesting is, you fast forward 5 years and we had a new CEO named Chuck Wilson, and he wanted to look at an acquisition. And so people phoned and said, well, we think you're the acquisition guy. And so you end up doing special projects for him, looking at acquisitions. And as time unfolded, one Friday, my boss came in and said, you're going to work in corporate strategies on Monday. And so, these relationships just kind of, work their way through over time. And I ended up doing a lot of merger and acquisition work. We evaluated a lot of things. We, did lots of big acquisitions. And there was a time when, there was probably a week didn't go by that I wasn't walking through the plus 15s here in Calgary with some multi-billion-dollar offer to buy one company or another. We did buy a company called BlackRock. I did work to represent the minority interests when Royal Dutch took it private. We bought a company called Duvernay, so Mike Rose's second company. Bought that. I spent a lot of time going back and forth to China, trying to do deals with the Chinese national oil companies, spent time in India. So a lot of different deals were looked at. I would argue, Shell, we started the rush on the Montney, when we bought Duvernay, and we were very aggressive at the same time on land sales. So I think we spent about $7 billion in 3 months putting a Montney position together, which is actually the underpinning for LNG Canada now.
Yeah. Do you think it helped the fact that you knew your old colleague, Mr. Mike Rose, from your early Shell days, and that was the reason why you were interested in Duvernay versus other companies that were in that area?
No, it came together a little different, really. So if I could, our exploration group had been looking at the Montney, and a fellow named Brian Fisher was running the exploration group at the time. And Brian had worked for me previously in other assignments. And he showed me kind of the Montney and the land position and where Shell had interest. And then we looked at the companies in the area, and right in the middle of this land that the exploration group was trying to pick up was this company called Duvernay. And it just seemed obvious to me that was kind of a, hand in glove kind of fit. So I did some work to put together a quick valuation of it. And I had a very good relationship with the senior executive in The Hague. And so there was a fellow named Malcolm Brinded. He ran the upstream business at Shell. And my U.S. colleagues repeatedly went to The Hague trying to champion and buying American companies, and they never got traction. Anyway, had a discussion with Malcolm. We talked about strategy. Shell was actually looking to make a much larger acquisition in the U.S., and I recall saying to him, instead of spending $45 billion, give me $15 billion in 5 years and we'll get you to a better place. And he said, okay, what's your idea? And so I had done some work on Duvernay and I showed it to him. And he said, well, this is interesting. And he said, well, what do you need? And I said, well, give me 30 days and we'll be ready. And he said, okay, we're going to cut through the Shell bureaucracy. Um, I'll be the sponsor. You'll have a steering team chaired by me. So we talked 2 or 3 times a week, and 30 days. And I said, by the way, Mike Rose is a former colleague at Shell, and so there's a relationship there. Anyway, so we were ready in 30 days, and Malcolm said, "Okay, how can we help you go faster?" And said, "Well, instead, there was a lot of procedure at Shell, and you had to write, briefing notes and go through the hierarchy, and everyone would have an opinion." And I said, "Well, here's my idea. Why don't you send the executives to Calgary? We'll present it to you. We'll answer your questions. You'll like it or you won't, and we'll go from there." And so it was actually July 1st. We snuck a team of Shell executives. They came to Calgary. I said, "It's stampede time, so wear cowboy boots and jeans. Don't wear suits and ties." And I started with a call with Malcolm. I think it was about 4 or 5 in the morning. He couldn't make it to Calgary, but he sent all his delegates. We spent the day reviewing it, tweaking our models, stayed up all night, presented to the executive committee in London by video conference the next day at 4:00 in the morning. They green-lighted it. They took it through the Royal Dutch Board of Directors on an emergency procedure. So we went through the Shell approval process in 26 hours. And they came and they said, "Yeah, you're good to go. You have a budget of $6 billion. So get some sleep, and you can call Mike on Monday." And so we went to see him. I think it was the first day of Stampede, and we made an offer and we shook hands like 24 hours later.
This episode is brought to you by Ambient. Ambient helps energy leaders improve production performance and expand margins through AI-powered optimization. Built on trust, transparency, and collaboration, the Ambient platform turns data into confident decisions, delivering measurable operational impact. Find out how Ambient expands the capacity of your production teams at ambient.com. And the idea was you needed feedstock for LNG and Shell.
No, at the time, actually, Shell just wanted, against their competitors, they felt they needed more North American natural gas production. They were very bullish on North American gas, and they just wanted more North American gas production. But as soon as we did the acquisition, we started looking at the possibilities for LNG. And yeah, that was like 2008. Now, it did take 17 years for the project to come on stream, but that gas that we bought was the backbone for the LNG project.
Right. Did you ever worry that the counterparty to this deal was very sharp and that you were perhaps overpaying for something and you don't know what the counterparty sees on the other side?
The counterparty being Duvernay, or?
Yes.
Well,
very sharp leaders.
Well, so I can tell you all these stories now. So we were going to these land sales. So the first land sale that Bryan and his team went to, they were blown out of the water. So we knew there was someone else bidding. And so the next land sale, Shell bid more aggressively and we won. And there were a couple of land sales and the price kept going up and up. And we didn't know it was Talisman who we were bidding against, but we didn't know it was Talisman at the time. But we were concerned about, we knew there was competitors out there and we didn't know whether it was Talisman or Encana. And so when we made the proposal to The Hague to buy Duvernay, I made it clear, like, if you guys want to win, we got to seriously bid here.
Right.
And we saw a lot of upside. And so when the way it worked at Shell is you were given a mandate. So you were given here's the maximum you could spend. And then you were kind of allowed to negotiate within that framework. But on Duvernay, they said, here's your mandate. and here's the bid you should make. And I thought it was actually too high because it was something like, it was like a 45% premium to the market. And I said, well, I think this is too high. And essentially they said, it's not your money. Just go get this, just go get this deal done, wrap it up. And they weren't concerned about overpaying because the view was there was so much upside.
Yeah.
And so we made the offer. And I knew they would spend more. And so Mike, we made the offer. Mike called the next day and he said, we're going to need more. And I said, there is no more. And he said, yeah, we thought that. We just had to ask. But I'd already talked to The Hague and said, they're going to come and ask for more and I'm going to say no. And they were comfortable with that. So yeah, we got it done. And, it was a win-win, right? So it was a large premium for the shareholders. Mike, being who he is, like the next day started working on his next company, which he's taken, frankly, to heights that none of us would ever imagine. And so it worked for everyone, right?
And the truth was there was tons of upside that maybe nobody even realized that they're still finding in that area.
It turned out that it was far bigger and better than even our most optimistic upsides of the day. Yeah.
Right. Because keeps getting revised upwards, it seems, even nowadays.
Yeah. So the last I looked, we had sort of a base case model that we did to underwrite the deal, and then we had an upside. And it's many-fold bigger than that upside case.
Did you ever worry that there was too much upside in that as a result, the commodity nature of natural gas would flood the market and prices would collapse? Did you ever think of that?
That's the part that we missed. So we underwrote the Duvernay acquisition. So there was a large debate amongst the Shell executives of the future of North American gas prices. At the time, gas was like $6 or $7 an MCF. And there was a view that it was going to go to 12. So we underwrote the deal at like something like a $7 gas price. And of course, we never did see that. And my view, probably never will. But there's so much upside in the resource that, it's going to be profitable. And of course, when you liquefy the gas and you sell it offshore, that's how you get the better price.
One of the main drivers is the liquefied aspects, all the pentane, propane, butane, those products that come with the natural gas too.
Absolutely. Yeah. Yeah.
A lot of value there.
Yeah.
But at the time, you weren't thinking that we were in for a tough run on natural gas prices. You had the asset model at $7.
Yep. Yeah.
Wow. A little different than today.
But that's the nature of the business. So this business is not for the faint-hearted, and people see the successes and the upsides. But it's an extremely volatile business. I would submit that no one can predict commodity prices, and so you have to have a business model that's robust to the downsides to be there to realize the upsides when they come.
And was LNG wasn't in the horizon at the time at that deal? It was later?
At the time, no. So Linda Cook had been a CEO of Shell Canada. So I worked for Linda for a while, and then she was running Shell's gas and power business, which was responsible for LNG. And her view at the time was that North America would never export energy, right? It was such a paradigm shift. We were always short of energy.
Right.
And so, today's scenario where we're energy long and exporting, that was unfathomable at the time, right? And but we did start to work with her people about the possibility of LNG right on the back of the acquisition, and eventually it came to fruition.
Shell has deep pockets. Did you look at other companies in the Montney Fairway other than Duvernay at the time? Because you could have rolled up. I think Progress was there, and there were some other ones that would have been.
We started with Duvernay because it fit with. We had a perception of where the sweet spot geologically was at the time, and it was the best fit. What's interesting is the initial plan was we were going to make this acquisition in Canada, and there was a parallel effort in the U.S. So we had identified an American company in a different basin. And the initial vision was we were going to do both acquisitions and announce them on the same day. So that project, frankly, couldn't keep pace with with the valuation we were doing here in Canada. And but no, we actually just honed in on that one target. I mean, $7 billion is a lot of money to spend even for Shell.
Right. And you saw all the opportunities at the time. Did you ever think about starting your own company and going off on your own at that time? This podcast episode is brought to you by JSG Professional Services, Canada's leader in pipeline construction management and inspection resources. JSG provides competent, qualified, and verified pipeline construction management and inspection resources, supporting Canada's largest pipeline companies from initial development through final execution. Whether your project involves new pipeline construction, integrity programs, maintenance pump stations, compressor stations, or inline inspections, JSG has consistently delivered experienced professionals to Canada's energy industry. Visit gsginc.com to learn more.
Well, at that time, so people would come and say, "What are you doing at Shell?" All my colleagues were leaving and they were being successful, and I found it tremendously rewarding. Right, so I was working on these multi-billion-dollar deals. Before working on this, we were working on buying oil sands companies. I spent 2 years. We tried at one point to buy all the mining companies in the oil sands. We made 3 or 4 approaches to our partners, Western Oil Sands. We could never come to an agreement there. We tried to buy basically all the other oil sands mining companies. There was a whole story behind the scenes of competitive bidding, working against our other multinationals. There was a time when a Chinese national oil company approached Shell and wanted to buy a major Canadian oil sands company. And I spent a year looking at the other big oil sands producers. And the vision was that we were going to jointly buy a large Canadian company. And, you can imagine who those names were. And Shell was going to create a downstream refining and marketing business in China, and we were going to ship this all through what was going to eventually be the Northern Gateway pipeline.
Mm-hmm.
So I got to work on these tremendously interesting, complicated projects, geopolitical implications. I spent a lot of time going back and forth to Beijing. We couldn't make that large acquisition make economic sense. But then, I said, well, instead of buying, I think I can name the names now. So we were considering, should we buy CNRL, Encana, or Suncor? That was the scale of what we were contemplating. And that seemed like a bridge too far. And so we said, well, what if we went smaller and looked at some of the smaller in situ companies who are putting together large land positions? And one of the companies that came to the top of my list was a company called Athabasca Oil Corporation. So I went to Beijing and I said, well, instead of working on these big companies, why don't we look at some of these smaller ones? And here's my list. And the one I would look at first was Athabasca. For various reasons, Shell decided that it didn't want to pursue that joint venture at the time. But then you fast forward a year and, PetroChina did a joint venture with Athabasca. I retired from Shell and I went to work for Athabasca. So,
right. It's easy to look back on all these assets and say which one was the best. But when you look back on things, is there any that got away that maybe you wish you would have bought? I mean, it's hindsight's 2020, but
yeah.
Maybe all of them. I mean, you could have got Suncor maybe.
Well, so when Shell wanted more North American gas, the senior executive at the time, a fellow named Walter Vandeviver, and Walter came and he said, well, I want more Canadian gas. Who would you buy? And we told him we would look at the company we wanted to go after at the time was Talisman. And so I had a all this stuff at Shell, it was like this top secret stuff. So I was, I could pick people out of the organization and say, well, you're coming to work with me for whatever, it might be a couple of months or 3 months or 6 months. So we did a very detailed evaluation of Talisman. I thought it made a ton of sense to buy it. And this was back when the royalty trusts were in vogue. And the business model was we were going to keep what we thought were the prime assets. And I thought we could sell the non-core assets and actually make so much money that we could pay the premium for the takeout of the company. So we worked that for 6 months. It was complicated because they had international assets. Frankly, we got into kind of a bun fight between our team in Canada and the team in The Hague about, is Canada going to run this project or is the international arm going to run it? And so we had a meeting to review this. So Malcolm Brinded, who I hadn't met, came to Calgary, and he was presented 2 projects. One was, let's buy Talisman, and the other was, let's buy out Western Oil Sands, our partner in the oil sands project. And so I was advocating for Talisman, and Neil Camarda, who ran the oil sands business, was advocating for Western Oil Sands. So I spent 3 hours with Malcolm, went through the pros and the cons, answered all his questions. And we were working for Clive Mather was the CEO at the time. And so Clive phoned me on Saturday and he said, well, here's the good news and here's the bad news. He said, and I'm not sure which is which, but he said, Malcolm wants to go after Western Oil Sands, not Taliesin, but he'd like you to take over running the project. So that's when we started working on Western, and then subsequently all the other oil sands companies. So yeah, there's lots of deals that you look back, woulda, coulda, shoulda. One of the big projects I worked on, if I could, so if you step back, so when I mentioned that I was sort of seconded to go work in corporate strategies, so I recall, like, I showed up there Monday morning, not knowing why I was there. And our CFO at the time came into my office at 8:00, closed the door, and said, well, here's what we're working on. So at the time, Royal Dutch Shell thought that the North American basin was mature and they wanted a way to exit. And so there was a project, and the idea was they were going to retain the downstream business, so refining and marketing, and the oil sands business and the East Coast offshore business, and we were going to take the Western Canadian mature business and merge it with a company called Renaissance. And the idea was we were going to create a new company called that would be Renaissance Plus, and it was it was a merger of Shell's technical expertise and Renaissance's entrepreneurial spirit. And we had this picture that they were playing shallow gas and we were in the foothills, and the middle where the juice was going to be what we now know as the Deep Basin. And this was a huge negotiation because you had to establish what we were worth and what they were worth. And so initially I was assigned to assess their value. And so we did that. And people might recall at the time, Renaissance had been a darling of the industry, but they were starting to miss their production guidance. Anyway, so Renaissance gives us their business model. And I opened it up and I thought, well, there's a mistake here. And if this is what you're basing your projections on, it's no wonder you're not making your guidance because there's a mistake in your model. Anyway, so we go into this negotiation with Renaissance, and I'd never negotiated a business transaction, and we're there with all the investment bankers and all this stuff. And I recall saying, well, I just have a question. I must have this wrong, but I'm looking at your model, and there was dead silence in the room, and that was essentially the end of the negotiation. So then, this is how my career went from just doing sort of technical evaluations to doing negotiations. And we were very, very close to having that deal done. And there were social issues about who was going to run it, and it fell apart. But
Mhm.
significant regret. That would have been a really good deal, and we would have created a great entity. So I have regrets over that. I have regrets that we didn't do the Talisman transaction. So
Mhm.
there's lots of woulda, coulda, shouldas.
Mhm.
But when you ask, well, why didn't you leave? Well,
Yeah.
here I was with the opportunity to work on these incredibly interesting, complex projects and make a difference.
Looking back on things, you did a lot of deals through the years, but how much do you think of doing oil and gas deals in a commodity business is just comes down to the right time where you could have bought assets, say, during the pandemic for pennies on the dollar, or I think it was around the year 2000 when CNRL picked up the BP oil sands assets, and it's almost just the right timing. Did you ever think of it that way? This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information.
So timing's important, but I think it's not everything. So I think you could. It's always hard to do. Deals are very hard to do, right? Um, because when you're in a downturn, the seller doesn't want to sell, and when you're in an upturn, it's too expensive, and the buyer can't buy. So my model is deals are always hard. Obviously, when you're a buyer, you would prefer to buy in a downturn, but when you're in a downturn,
The seller doesn't.
well, you're never sure, is this like there's always is this the new normal, or are things going to turn up?
Right.
Um, so I actually push the environment aside. The magic of a deal is, for me, there's in my mind sort of natural ownerships, and there's times when it just makes sense for the seller to sell and it makes sense for the buyer to buy. And you can do it in low environments, higher environments, and mid environments. And that's where, kind of to use the orange guy from down south phrase, there is an art of the deal, and deals are always hard. Um, I always try and put myself in the perspective of the counterparty to try and find, the space, like what would work for them and what would work for us. And you can't always find that space, but very often, if you work hard at it, you can find something that works for both sides.
The best deals are the ones you buy at the lows, which nobody knows. But did you find there was value in win-win too in the oil and gas business?
Yeah, I think you don't always. Obviously, buying at a low, like there's times when if you buy low enough, you almost can't lose. But I think that's not the only time when you can buy. And if you're just waiting for the lows, I think that's a mistake. I think there's opportunities at other times in the cycle as well.
And there's assets that have been around for a long time, and it's almost patience that gets rewarded. Did you find that it was valuable to just wait and that eventually maybe someone will change their mind and that you could peel off the asset eventually?
We had times where we made offers, and they were, in my view, very robust offers at the time. The counterparty didn't want to sell. I had multiple times when they came back a year later and said, well, we'll sell now. And, the message was, well, we're no longer interested.
Right.
We tried sometimes to resurrect deals that had fallen. That's actually very hard. Once you part ways, it's hard to go back.
Mm.
And I never had success actually resurrecting a deal that fell through.
Mm. Well, we could talk about deals for a long time, but maybe we'll get into Aspenleaf
Sure.
nowadays.
Yeah.
You came out of Shell, went to Athabasca for a bit, and decided you wanted to start your own company, more or less. But what made you want to start Aspenleaf at the time that you did?
Yeah. So if I step back, so I came out of Shell, I'd worked on all these big things. Quite frankly, I didn't really have the self-confidence like that I could do it. And you had this, at least I had this doubt, said, well, but I always had the army behind me, right? So I could get the resources of Shell, and I wasn't sure whether I could do this without those kind of resources behind me. So I went to work for Athabasca, and it actually built my confidence that, yeah, I had a lot of resources at Shell, but I wasn't totally reliant on them. And so when I left Athabasca, and even when I was at Shell, you'd get inquiries from the private equity firms. Would you like to start something up? Because they'd had a lot of success with a lot of my colleagues there.
Yeah.
And in fact, just to go back, when I was working on the Duvernay acquisition, my friend and colleague Brian Schmidt was trying to start his first company, and he was trying to convince me to go work with him at the time. But I was working on this exciting stuff. Anyway, so I took a little bit of time off and started to think about, well, maybe I can start something. And I talked to a number of private equity firms. ARC was the first to call. I knew them very well. Mac Van Wheeligan had been on the board of Western Oil Sands, so we had built a bit of a relationship and trust. And actually, a number of the people that had worked for me at Shell were then working for ARC Financial. So there were lots of common bonds. And I thought it through, and I decided that, yeah, I was prepared to start. But there were a couple of conditions. One was I was only prepared to do it if I could get the right team. And I'd had a vision of some of my former colleagues at Shell. And team chemistry was really important for me, not just chemistry, but chemistry and skills. So I was only going to do it if they said yes. Second condition was the amount of equity. So I was interested in doing it, but I had a bit of a strategy in mind, and it was going to require more financing than the typical private equity startup at the time. So ARC invited me to come think about life. So they had a program called Executive in Residence. And quite frankly, the draw at the time was they said, we'll give you an office and a parking spot. So I spent a couple of months sitting with ARC, kind of crystallizing my thoughts, and kind of formulated a strategy based on acquisitions that I thought made some sense. ARC liked it. I called my former Shell colleagues, and they said, yeah, we're in. And as soon as a couple of them said we're in, ARC said, good, we're good for the first $100 million. And I said, that's good, but we need more. And so eventually we launched the company with $350 million of equity. And we went from there. And it was all based on strategy that there were companies and assets that had unrealized potential. And they were in situations where they needed to sell or wanted to sell for one reason or another, and that we could buy these companies and wring greater value out of it than the incumbent teams. And so that's what we've done.
First deal was Arcan in 2015, I think.
So the first deal was Arcan. Actually identified that as an opportunity while I was still in residence with ARC. And when you do private equity fundraising, so if I step back a little bit, so the model with ARC was, I said, we need a minimum of $300 million of equity, and that was too big a piece for ARC themselves. So they said, we're good for 100. And then they said, we'll bring in Ontario Teachers Pension Plan, and they'll put in 100. And initially there was going to be a U.S. private equity firm that was going to put in the third 100 tranche. And then as we talked, ARC said, well, investors these days really like what's called co-investment. So co-investment is they're invested through ARC, but they make an additional investment kind of directly into the company. And so they said, well, would you entertain co-investment? And I said, sure. And so we did like it's kind of like a version of an IPO. So we went and met 20 of ARC's investors and said, here's what we're trying to do. We're trying to raise money. We were seeking 100 million. There was interest well over 200. So we ended up taking like 150 of that. And so we launched with ARC, Ontario Teachers Pension, and a significant number of these large co-investors as our foundational base.
And that was 2015, which in hindsight was a good time to start.
Sorry. So when we went to do this marketing, we'd already worked on Arcan. So we actually had a business proposition, and so this wasn't just a very hypothetical situation. We had here's a real world example of what we could do. And then shortly after we finished our financing in 2014, we actually approached Arcan to do a deal.
Mm.
And at the time, and the reason we thought they could do a deal is they were heavily in debt. They had these convertible debentures. They were underwater. And we tried to do a deal that was frankly impossible. So the management didn't want to sell. So we tried to do a transaction where we paid the debt holders less than 100% on the dollar, but we also were trying to give some value to the equity holders so that they would sell. So we tried this ridiculously crazy deal and it didn't succeed. So this was in 2014. But what it did is it crystallized the debt. So then the hedge funds came in, bought the debt, and then it took us a year, but we were able to consummate the deal. But it took us a year to buy the company that we'd identified.
This episode is brought to you by Astro Oilfield Rentals. Out in the field, weather changes, markets shift, and projects move farther and farther from home. But one thing never changes: Astro Oilfield Rentals will be there for the long haul. Astro is more than just well site shacks and internet systems. They're a partner you can count on. Whether it's -40 on a remote lease or the toughest terrain you can imagine, Astro shows up, delivers, and keeps you comfortable and connected. Astro Oilfield Rentals is there for you no matter the mile. Learn more at astrorentals.ca. And typical private equity is relatively short time frame. Maybe flip the company in 5 years and get a nice return. But what was your value proposition to them, and how did you think about the business plan? Where was it going to go?
Well, at the time, oil was $75, so we bought Arcan. We didn't use all of our equity lines, so the idea was we were going to do more.
Right.
And of course, then oil collapsed.
Yeah.
And so we did the best we could. And we still had this undrawn equity line, so we had access to more capital. Initially we were going to try and roll up all the producers in the Swan Hills area, and we had some misadventures there. But we started looking, and initially, our backers said, "There's no rush; you have time." And of course, then it became a little bit of, the clock's ticking. But we were patient, and then we identified. So we thought the market had moved, and we thought we can't buy public companies. The valuations are now too high. So we turned our attention to the private companies. And the opportunity we saw was, to your point, private equity has a time frame. And we said, well, okay, there's some companies that have good assets, but they're running out of, so they're not in financial distress. They're just running out of time. Mm-hmm. And the company that rose to the top of our list was a company called NEP. Right. Now, that's not NEP. That's not Trudeau's NEP. It stood for Newton Energy Partners.
Yep.
And they had tried to sell the company a number of times. And so in 2016, we tried to work a deal with them. And it was unique because we didn't offer them all cash. It was cash and shares. And we had this deal. We kind of had a handshake, and then prices softened again. And for a variety of reasons, the deal didn't get consummated in 2016, but they wanted out. And so again, it took us a year, but we were able to conclude the deal in 2017. Mm. And it was unique because even then, the U.S. private equity firm who was exiting took some shares in Aspenleaf going forward. So again, we were known not just for finding assets kind of, I'll say, off the beaten path, but we also were, because of my experience, we were prepared to do some fairly complex transactions to make it work for both sides. And both of those deals were, not straightforward transactions.
And your backers were patient enough that you could say, this may take longer than 5 years and you'll get your return eventually.
Um, they want, things were unfolding to where 5 years just became unreasonable for everyone. So they gave us more time, but we were always conscious that time wasn't infinite.
Mhm.
And, but they did give us the latitude for more time. And then, we started to have more and more success with crystallizing and realizing the underlying value of the assets. And so we had financial success, and our model was all about not just promising you a glorious future, but generating attractive returns, like real free cash flow and returns. And so as the investors saw that this was real with real cash and real cash flow, you know, that buys you credibility and that buys you time as well. And so that was part of the formula.
And did you pay a dividend along the way?
So initially, so we're quite risk averse. So unlike private equity, who often, uses significant leverage and debt to get their return on equity, we're much more conservative in terms of the debt profile, which makes it harder to generate a private equity return, but it's more robust. So the first thing we do when we do acquisitions is we pay the debt down to what we would consider a more comfortable level. And then we were able to pay the debt down and then start paying returns back to our investors. So that buys a lot of credibility, right? When the money starts showing up in your bank account, when it's not in the spreadsheet, but it's actually in your account, that makes a big difference.
You got NEP in 2017. When you look back on it, did you get a good deal?
We got a great deal. Yeah. It is our crown jewel. Um,
It was about 15,000 BOE a day.
we're producing right now sort of in around 16,000 BOEs a day. We have a different philosophy, so we try and stretch out our inventory. So we like kind of production plateaus, and we stretch it out, but we generate very, very attractive free cash flow out of that asset in particular. So it's worked out spectacularly for us.
And nowadays, you're drilling about 20 wells a year across the 3 assets with a single rig on all of the properties, I think. That's the idea, is just to keep consistently drilling?
Yeah, so we drill pretty much through the year. We drill about so to maintain our production at 25,000 barrels a day, we need a couple dozen wells a year. And so we keep one rig moving. We move it between the 3 assets. Works out well for us. We're thrilled with our relationship. So, from a cultural standpoint, we really believe in relationships with our communities. I'm really proud of some of the work we've done with First Nations, with our local communities, but we also work very tightly with our suppliers. We have really great relationships, and it's a win-win for both. And so, yeah, right now we're using a Savannah rig, and we move it between the 3 assets, and it's working out great for us.
And the idea is to consistently grow oil production for the next 5 years, unless someone tries to buy you.
Actually, the idea is right now we're at a point where we can just keep it at 25,000 barrels a day. So here's our business model: 25,000 barrels a day. You're producing roughly 9 million barrels a year. And our business model is produce 25,000 barrels a day, 9 million barrels a year. Every year we add 9 million barrels plus of new reserves. So we're like a perpetual motion machine. Produce 9 million barrels, add 9 million barrels, take out free cash, and do it again next year. And the business model is just every year, replace your reserves, take out the cash, and do it again. Now, if we manage to grow our inventory to where our flat life is too long, we can look at moving our production up. But we're kind of in about our sweet spot right now, 26,000 barrels a day. But we are working on things that will extend the life. So we do a lot of water flooding. We're looking at enhanced recovery. And with continuing success, we'll have a legitimate case to grow the production, but we don't need to grow. All we need to do is generate superior free cash returns at our production level, and we can keep going.
And do you think of doing or experimenting? I think you do experiment with waterflood programs, polymer programs, SAGD. Do you ever the enhanced oil recovery strategies? How does that fit in?
So the premise when we bought Arcan, so they were running a water flood. So I had worked. That was one of the areas that I had responsibility for when I was at Shell. And their water flood was booked to a 15% recovery factor. And I knew that it would get 35%. So that was the driver for it. We just saw that there was this latent potential that was not recognized. So we run a very successful water flood at Swan Hills. Our capital efficiencies are not our best there, but the decline rate in the asset is somewhere between like 0 to 5%. So we can keep Swan Hills flat by drilling 1 or 2 wells a year. And we've expanded the water flood. We've doubled the area. We'll continue to grow the area of underwater flood. And it just works. And it generates free cash flow because it's got a low decline rate. It's light oil. It has a high net back. In Leduc, Esso had run water flood and then stopped. And we've now started to reinvigorate water injection. So we're doing water injection, you can call it pressure maintenance, and we're seeing some positive signs there. And Esso also ran a pilot with a hydrocarbon flood, and we've taken a close look at that. And we're working towards a demonstration project to see if that makes sense in Leduc. And then in our Twining asset, we've started to pilot water flooding. It's early days. We're a couple of months in, but our view is, if we can take recovery from 10 to 15% with primary to 20 to 30 to 40 to 50 with enhanced recovery methods, for us, that's a no-brainer. And we'll continue to do that and look at that across all of our assets.
There's other companies getting a lot of success with waterflood programs in the last year or so, like Tamarack and Obsidian, and as you know. But why? What I'm curious about, if I'm thinking about, is why now? What changed so the waterflood started to work recently?
So I think the industry lost its way. This used to be we used to all do this stuff, and then with the onset of the resource plays, everyone lost sight of kind of this established technology, and it became, well, we're just going to drill. And there was this view that you didn't need to do the stuff because inventory was like infinite. But as we all know, there's tiers to the inventory. And when you exhaust the tier 1 stuff and then the tier 2 stuff, then you start thinking about what else can we do? I think it's a little bit sad, frankly, that the industry lost sight of these techniques, because if you think about this, like, it's totally wasteful to leave 80 or 90% of the hydrocarbon in the ground, especially when you've built all the infrastructure, plants and roads and pipelines.
Yeah.
So I think we're rediscovering our past in a very positive way. And I'm really optimistic that, we're going to find more and more ways to get more of the hydrocarbon out of the ground. And it's a win, not just for the industry. This is a huge win for the citizens of Alberta. And, when you look back, like, the regulatory body used to be called the Energy Resources Conservation Board, and it was all about making sure we maximize the long-term value of the assets. I think we, over the journey, lost sight of that, but I think we're rediscovering that.
And then from an investor's perspective, things like water flood and polymer and those types of techniques are great because it's a low spend and you get a bunch more oil back.
So I think about the business, so eventually, like, cash flow doesn't lie. And eventually you have to, the cash that you promise your investors eventually actually has to show up. You can't just promise it forever.
Yeah.
And it's governed by 3 factors. It's governed by your net back. So that's like the price you get, the quality of your product, and the cost, your cash costs. It's governed by your capital efficiency. So how much, because it's a declining asset, how much capital do you have to put in every year to maintain your production? And then it's governed by the decline rate. So if you have a low decline rate, you need less capital. And so that's what makes the cash wheel work. And some assets can have a lower decline but poor capital efficiency, and that's okay. Or sometimes you can have a great capital efficiency, but you're fighting a higher decline. And it's that combination in whatever combination works that generates a successful business. So this is our business model, and we focus on free cash generation. And we have, as I said, some of our assets have better capital efficiencies and some of them have lower decline rates. And of course, the holy grail is, my gosh, if you can find an asset with great netbacks, great capital efficiencies, and low decline rates, that's fantastic. And I think, Brian Schmidt, credit to him and what he's doing in the Clearwater, I think those assets are going to have all three of those attributes, and real credit to those companies for having the foresight and the skills to unlock that potential.
And another thing I've been thinking about is that people are realizing the potential, or real or looking back and rediscovering it. But so now people are looking around for those assets now. It's not a secret. So you have good assets like that already, but as more people realize the potential for those old recovery techniques, do you think that the market will dry up for those assets? Are there a lot of them lying around?
We keep looking for more. Maybe there's more. For Aspenleaf, we're in a great spot because we've captured assets, and our strategy, we've changed a little bit. Private equity typically is, as I said, 5 years and sell. But we've moved ourselves. We recapitalized. So a few years ago, time was up for our investors, and so we put the company up for sale. We didn't find that there were bids that were both attractive and that the counterparty could actually finance. And so we, now my CEO, Keith Pomedley, he was our CFO at the time, we talked and we said, well, if our investors want to sell, we should look at just buying this company because we believed in it. And so we approached our investors and we said, look, we don't know if you want to stay or if you want to sell, but we'd happily, frankly, buy the whole thing. And some of our investors said, no, it's time, we want out. And the majority of investors said, no, we'd like to stick with it. So we recapitalized the company. Ontario Teachers' Pension exited. Some of our smaller investors exited. ARC Financial actually not just stayed, but put more money in through other funds. And our large co-investors that have been with us from the start, they all stayed. But now we're in what's called a continuation vehicle with a different time horizon. And as long as it makes more sense for us to run the company and take the cash flow out ourselves, we can do that. But we're commercial people, and if someone wants to buy the company at some point, we're not entrenched management, but we're in a great place where we don't have to sell. We can sell if we want. We can look to buy more things if that makes sense. And our base case is we now largely control our destiny because we have the assets. We're subject to the volatility in commodity prices, but we're incredibly robust. So anything over $40 WTI, we generate free cash. So it's just a matter of how much.
So it's kind of evolved into your own little vending machine, bank teller.
Yeah, it's we think it's an attractive business proposition, and we're all about creating value for our investors and our shareholders. That's who we work for. And yeah, we're very pleased that we're able to generate what we consider superior free cash flow returns, so yield on investment, and it's good for all of us.
What about liability? Does the company have a lot of wellbores, and how do you think about that? Because sometimes that deters buyers, but
so we did a lot of work. So one of the reasons that people didn't look at the Leduc asset is because it goes back. It's the original Leduc field going back to 1948, and they were scared off by the perception of liability. one of my colleagues from Shell, he was running the onshore business in the U.S., and he had a lot of experience with legacy liabilities. So we did a lot of homework. We had a pretty good assessment of the scale of the liability. And when we went to our investors, we showed them the work and we said, look, there's a range of estimates here, but this is the way we assess it. And they said, okay, we're prepared to back this investment with the proviso that we actually seriously get at cleaning it up. So we're not sort of fly-by-night guys who just strip out the cash and turn the problem over to the province. And so in Leduc, we've spent many multiples more than the minimum required to spend. We initially abandoned about 2/3 of the inactive wells, and we were spending 3, 4, 5, and in 1 year, I think 8 times our minimum requirement. We got on top of the well abandonment question, and for us, that became not an issue. The big issue in Leduc is, or in our mind, was, what was left behind from past practices, sumps and drilling waste disposal areas. We had a pretty good estimate of what that was, but we undertook a few years ago to truly assess that. And so the way you do that is, I call it playing battleship, but you drill holes into the ground. So you have a good sense of where the contamination sites are. And we drill these holes and you delineate it because we wanted to know exactly where it was and how much. So we spent $8 million in a year as we did these, what are called phase 2 assessments on over 90% of the sites. And I would submit we probably have the best data set of a legacy site, maybe in the world. Mm-hmm. So we've got data going back to 1948. And as we looked at it, we started to question what the best practice is going forward. So we're actually working with the Department of Environment now on a little bit of a pilot project to come up with a better approach for the province on how we can accelerate closure on site. So we're quite excited about that. But our intent was never to leave the liability for a future generation, and we will deal with it in the best pragmatic way we can.
So things are going well at Aspenleaf.
I think we're doing, knock on wood, we're doing pretty well.
And if someone was to listen to this podcast and say, I want to invest in Aspenleaf, you're not public, is there any way for someone to invest? Are you taking money? I don't think you need money, but you're a private company?
No.
No way.
So we don't do friends and family. That was always too much pressure for me. We do look, if it makes sense to make some acquisitions, we would need more equity, but our business model is, we get large, long-term investors. So no offense to your listeners, but
or
no,
myself.
we're not open for investment. But we're really grateful for the opportunity, the backing that our investors have given us, and I feel like it's not just about making money. Like, we do good things with our communities. We do good things with the First Nations in the areas we operate. And we contribute a lot to the economy of the province and the country. And we produce energy that the world needs. So, this is not just about making money for us. We are really proud of how we conduct ourselves. And we think we add value to our society. And that, for me, is what it's all about in the end.
Yeah, I've covered that on the podcast a bunch before, but energy is not even correlated. It's almost causal to human development and prosperity. And you need energy for more technology, and it makes lives better in a nutshell.
Absolutely. So we're firm believers in that. We spend a lot of time, advocating for sensible energy policy. And we're really grateful that things have turned out, knock on wood, better than we ever would have hoped. And it's been a great ride.
The Alberta oil production hit a record, I think, this month. So you've studied the Alberta and the basin for a long time on the subject of the well-being of, I guess, Albertans and Canadians in general. Do you think there's a lot more potential for oil production in the province, in Canada?
The world is our oyster. So the reality is, there's about 8 billion people on the planet. 1 billion have access to energy like we do. 7 billion do not. We're resource rich. I spend a lot of my time now on, call it, political and civic issues. It's kind of heartbreaking that we have put these impediments in front of ourselves to realize our potential. But I'm very optimistic that there can be a great future for Western Canada, certainly with the resources we have. And, maybe Canada can get out of its own way and realize its potential. And it's good not just for Canadians, but I think we can contribute on a global basis.
I think the production was like 4 million barrels a day recently is what the record's been at. But what do you think it could get to if we got it out of our own way?
I'm a free market, free enterprise guy. So I'm not into forecasting. I think it's unforecastable. I would suggest for the province, just take it one step at a time. I'm a view of, make it possible for it always starts for me with a buyer and a seller. Right? So I don't worry about the infrastructure. I start with, okay, there's people that produce and there's customers for our product. And in a free market economy, buyers and sellers work together for mutual benefit. And then what we need is a framework here where if the buyer and seller see a business deal, the infrastructure that's required to get them connected up can be built. And that's what we need. And the more government gets out of the way and just lets free enterprise and entrepreneurs work, the better we'll be. How big we can be, I don't know. But I know we can be a lot bigger than we are now. And we've got incredible resources, not just the physical resources in the ground, but we've got, the infrastructure, we've got the service industries, we've got the educational skills. And I think a future generation will look back and see this was just the start of something much bigger.
It's February of 2026. Where does Aspenleaf go from here? Wrap things up.
We're one step at a time, right? So we'll continue drilling. We'll continue producing in around 25,000 barrels a day. We'll continue doing returns for our shareholders. We give them a return, a couple times a year. We'll look around to see if there's another needle in the haystack. And if we find it, that's great. And if we don't, we'll just keep doing what we're doing. And, we'll produce in accordance with what we think are the right ways, dealing respectfully with our communities and honoring the commitment that our investors have made in us. And we'll just keep going one day at a time and good things will happen.
I really appreciate your time today. And unfortunately, I can't invest. But thank you.
Thank you.
And quick shout out to Dan Hallock for connecting us.
Oh, you bet. Dan and I were at the hockey game last night, and it's just a testament to what relationships in this community do. So it's really important for us. And there is no community in the world in the oil and gas that's anywhere close to the community in Calgary. It's something we should be really proud of.